For long-term investors, managing cash is increasingly difficult as short-term interest rates fall. Although cash seems safe, holding too much can undermine long-term financial goals. Right now, there's a record $7.3 trillion sitting in money market funds, reflecting a shift towards cash as investors wait out potential market uncertainty. Investing isn't about choosing between risky assets and cash or timing the market. It's about having the right mix of assets for long-term goals. Cash plays a role for liquidity and emergencies, but excess cash, more than needed for short-term needs, can lead to missed opportunities for growth, income, and risk management. Over the long term, stocks and bonds have consistently outpaced inflation. For example, what cost $1 in 1926 now costs $18, but stocks and bonds have grown much more. Even after market pullbacks and recessions, they've created wealth for those who stayed invested. This year's market rebound shows how quickly pessimism can turn into growth. The compounding effects of returns above inflation can build wealth over time. Holding too much cash comes with hidden cost. First, inflation. Even when interest rates on savings or money market funds seem good, they often don't keep up with the rising cost of goods. In fact, the real return on cash has been negative for most of the past 2 decades when adjusted for inflation. Second is reinvestment risk. Interest rates on cash are very low. If rates fall, investors could face lower yields at each maturity. With short-term instruments, you're forced to reinvest at whatever rates prevail, often below inflation. In contrast, long-term bonds lock in yields, protecting against this risk. From a financial planning perspective, cash does provide essential liquidity and flexibility for near-term spending needs and emergencies. For instance, a down payment for an upcoming home purchase will likely involve holding cash-like instruments, as would tuition payments and other bills that need to be paid within a year. Maintaining an emergency fund provides important protection against unexpected events like job loss or medical emergencies. As I mentioned earlier, money market fund assets have surged to $7.3 trillion, nearly double pre-pandemic levels. While high rates made cash attractive in the short term, those rates are now expected to fall, creating challenges for investors holding excess cash. This cash on the sidelines may eventually shift back into stocks and bonds. The best way to handle excess cash depends on your goals, but strategies like dollar cost averaging can help. As the market continues to rally and bond yields remain attractive, staying invested in long-term assets is still the best way to achieve your financial goals. The bottom line, cash serves an important role, but holding too much can create hidden cost. For long-term investors, maintaining an appropriate cash buffer while staying invested in a diversified portfolio is the best strategy for meeting your financial goals.